Okay, we're going to have a look at the 2018 published accounts question in this video. Published accounts was question 6 on the 2018 exam, and it's quite a good published accounts question. It's the most recent one we have. So you're given a trial balance for Capital PLC with all of the information therein, and then you were on the next page. You're given 8 adjustments which have to be done before you can prepare the published accounts. Of course, with published accounts, the template or the structure of the accounts are all important, as is the notes. The notes at the end of the question. You see where it says Part A of the question: prepare the published profit and loss account and a balance sheet in accordance with the Companies Act. That means the actual template, and then also show the following notes. And there are 1, 2, 3, 4, 5 there, which those notes are the same every time. We just need to know them off. And of course, there are also 10 marks of theory in this question. So let's get stuck into the adjustments. And what I've done here is I've put up this allocation of expenses. Every time I teach published accounts, you will have seen one of these, where we're going to record what is an actual cost of sales, what is a distribution expense, and what is an administration expense. And then we'll get our 3 totals at the bottom. So we can start off, before we even do the workings, if you wish, we could start off by putting in these 3 here, the opening stock, the purchases, and the closing stock. And we know that those make up cost of sales. So we can put them in the first column. Opening stock and purchases directly from the trial balance. And closing stock is working number 1, which I've listed over here, and it goes directly in. So closing stock is 86,000. So therefore, we can skip on to working number 2, where it says the patent was acquired on the first day of January 14 for 63,000. So now, the first day of January 14, that's 3 years ago in this question. But as long as we know the original cost, and which is 63,000, and as long as we know by how many years it has been written off or amortized, well, then we can divide the 9 years into the 63, and that is a write-off of 7,000 per year. It says this amortization should be included in the cost of sales. So again, we're safe to put that 7,000 in there. And of course, when we get to the balance sheet, you will see in the trial balance there the patent is actually worth 42,000. We're going to take off another 7,000. Sorry, there's actually a misprint there. That should be 7,000. And that's going to give you 35,000 as your intangible fixed asset in this question. And that's all entailed in working number 2. Now, working number 3 is an important working. It says provision should be made for the following, and there were 5 things here. Now, the phrase provision should be made, that means these things have not been paid or received yet, but they will be before the end of the year. So therefore, we must make a provision for them, or they will be by the end of the following year. So when we do our debenture interest, just like we would do at final accounts, we work out the rate of interest and the loan, which is 7% of 300,000. Now there's no months here, and we have it for the full 12 months. So therefore the expense is 21,000. We don't put that into our allocation of expenses because debenture interest has its own place in the published profit and loss account. You take away how much is paid, and you'll find out that there is an amount due, and that amount due is a current liability. It will go in as a creditor in the liabilities, or in the current liabilities. Investment income is almost the same working. You take the investment by the percentage of interest we earn. We only got the investment on the first day of April 2017. It's the 3rd figure down in the trial balance. So therefore, we should be entitled to 13,500. We have received this much. So therefore, we're still waiting on 5,100, which is an investment income due, and that is a current asset. Now, the corporation tax, we don't need to do anything with it except know where it goes. It is an expense, but it has its own place in the profit and loss account, and it is also a current liability. And then these auditors and directors, well, they are both administration expenses, and they both also are also current liabilities. I'm going to put in current liabilities by 2 there. So um, over here, we can go and say, okay, both of you guys need to go into the administration expenses. 16,000 we pay our auditors, and 32,000 we pay our directors, and they can go in. Okay. Working number 4 says included in the distribution expenses is a receipt of 15,000 for patent royalties. Well, patent royalties, of course, is an income, and that will be counted amongst the incomes at 15,000. To take an income out of an expense, we actually add it on because our distribution expenses are being artificially weighed down with a credit of 15. So therefore, we need to put 15 on the debit side. So patent royalties removed actually will increase our distribution expenses. So we're going to put that 15,000 in there as a positive in this case, or as a debit really, to cancel the incorrect credit. Then we have our depreciation of buildings. Now, this is paragraph number 5, working 5. Actually, it also talks about revaluations. So during the year, land adjacent to the company's um, premises, which cost 80,000, was sold for 167,000. I'm just going to make a note down here to say that that profit on land is going to be 87,000. But of course, we're given that figure anyway in the trial balance, in the very dead center of the trial balance. And then it says at the end of the year, the company decided to revalue its buildings up to 850,000 and incorporate this in this year's accounts. Well, a fairly basic revaluation here, you put in the trial balance numbers, which are 760 and 81,300. If we want to bump this up to 850, we put 90 on the debit side here and transfer it to the credit side of the revaluation reserve. Now, I should have probably mentioned this earlier, we have got this year's depreciation, the profit and loss figure for depreciation, which is 15,200. That is 2% of 760, and we get that 2% from working 6, 2% straight line. And then when you do that, then you wish to cancel all of this depreciation with your revaluation. So you put 96,500 there, which is a combination of these two, and you bring that from the debit side here to the credit side. Revaluation is something we should be familiar with at this stage. Now you actually have 850 as your buildings, and you have 0 depreciation because, of course, on both sides here we have the exact same amount, which is 96,500. And you have a revaluation reserve which goes into the finance buy of 1,865. Now that brings us on to paragraph 6 anyway, and paragraph 6, of course, talks about depreciation of buildings, 2% of straight line, and it is to be allocated 40% to the distribution expenses and 60% to the admin expenses. So therefore, you take your 15,200, which we had to work out, and you split it here 40-60 in the two columns. And then depreciation of delivery vans, well, that is a straightforward 20%, but it is 20% of the reducing balance or of the net book value. So therefore, you have to take off the accumulated depreciation of 116, and that gives you a net book value of 164, and it is on that that you get depreciation of 20%, which gives you 32,800. And that figure of 32,800 you put in here as a distribution expense because you use your delivery vans to distribute your products. Paragraph 7, and indeed working 7, it says the company has been sued by a former employee who is claiming unfair dismissal and is seeking €100,000. But because the company's advisors have stated that the contingent liability of 100,000 is unlikely, it need not be included at all. So therefore, the key word there is that it is unlikely, and that we will lose that case. So therefore, we don't include that 100,000. However, the company has received an invoice for legal fees to the value of 5,000, and that this must be provided for because we have to pay these solicitors. So therefore, the legal fees are an administration expense. Up here they go. And also there will be a current liability because at the moment they are unpaid. And then paragraph 8 states that the company has entered into a preliminary contract with a construction company to build an extension at a cost of 400,000 and improve the current premises as well. Um, Preliminary contract, no, nothing has happened yet, and no money has changed hands yet. So therefore, it does not need to be um, referenced in our accounts, but it does in the notes. It must be referred to in note 4 in this question, where in note 4 asks you about capital expenditure commitment notes. It's something that they're planning to do, but it hasn't happened as of yet. Now, well, let's go back up to here for a moment, and now we can see there are a couple of other expenses. Once you have done all of the workings and exhausted all of them, there's a couple of other ones then directly from the trial balance. Of course, you would find expenses in the debit column. So there's administration expenses, distribution expenses, and there was carriage in, which is a new thing here. But of course, normally speaking, we add carriage in onto purchases. It is no different here, except we have to do it in the preparatory work, not in the face of the accounts. So therefore, in here, you add up all three of these numbers, and those are your three expenses which have been totaled. That's all of the workings done. So now we can go and have a quick look at the question. And of course, this template, while it's important that you learn it off precisely, it's quite familiar to us, really. The turnover is just a fancy word for sales, but we do have to take away sales returns. So therefore, the turnover is actually 1780. Sales returns are called returns in this question. Now, the cost of sales calculated above in the first column to get your gross profit. And then the distribution and the administration expenses are both also calculated above in column 2 and 3. So the first tricky bit here really is the other operating income, and that is any of the gains. Now in here, you look in the credit column for an income, and you'll see that we have discount, the second last number, and we also have rental income around about the middle of the question, and we have the patent royalties. And when you add all three of them together, you get 82,000 euros. You take your gross profit and you take away the two expenses and you add the income, and that gives you an operating profit of 208,400. Here are some further incomes and expenses. You have your profit of sale of land. It's what we call an exceptional item of 87,000. You have your investment income, and you take away your interest payable, calculated in working 3. And that gives you your profit before tax. Also in working 3, we had our corporation tax. We take that away to get your profits after tax. And that gives, then you take away your dividends of 55,000, which is given to you in the question, around the center of the question, to give you your profit retained. And then you add on last year's P&L balance, normally speaking. But actually in this question, the profit and loss balance is a debit balance, which means they're carrying forward a loss of 42,500 from last year. So the new P&L figure is 141,400. That's the first page. Then we look at our balance sheet. Well, the intangible fixed assets are the patents from working 2. The tangible fixed assets, you work that out with your note number 5, and I'm going to look at that in a moment. But for the time being, trust me that that's 981,200. I'm going to show you where that number comes from. And the financial fixed asset is, of course, your investment. Your stock is working number 1, straightforward. Now the debtors at 115,600. I have a note down here to show where some of these figures come from. So debtors, you can just about see it on the screen there. Debtors are going to be 115,600, and that comes from your actual debtors less your provision for bad debts, but then you have to add on your investment income due. And then when you total all of that, you get 115,600. The cash or bank figure given to you directly in the trial balance. Then you have creditors. Creditors are the trade creditors, but then there are other creditors of 60,700. Now, where does that come from? Well, that is the things which are due but unpaid. A lot of them from working number working number 3, actually. You have your auditors, your directors. You also have your legal fees of that 5,000. This is something which has to be paid. And finally, you have also your loan interest due of 7,700. All of those four go up to make up that 60,700. And then tax is not straightforward either, because in the tax you have corporation tax of 49,000, but you also had VAT of 34,200, which is also a liability. You have to combine both of those to get that figure. Then you take your liabilities away from your assets to get your working capital, or in this question we call it net current assets, and you add that to the above fixed assets to get your total assets less liabilities of 1,347,900. The finance by section, well, you have your debenture, and the debenture is 300,000. Then you have your issued share capital of 720,000, no share premium in this question, but then you have your revaluation reserve, and of course, from the bottom of the first page, you have your P&L account. Capital employed must equal the total net assets, and that is the full set of accounts done. There are still significant marks to be picked up, though, with the notes. I'm going to refer down here to these notes. And some of these we just learn off. The first one here, tangible fixed assets. You're talking about the depreciation of your fixed assets. Depreciation calculated in order to write off the value over the estimated useful economic life. And you talk about how it's 2% for buildings and it's 20% of reducing balance for delivery vans, 2% of straight line for buildings. And you can mention that buildings were revalued. Closing stock valued on a first in or first step basis at the lower of cost and net realizable value. These are standard and we've learned them all. The operating profit is arrived at after the following is charged: depreciation of fixed assets, patents, directors and auditors, and legal fees in this case. In here, we always put things which are open to the discretion of the company to decide or declare. Then you have your dividends. Bold that there. Dividends, you work out your total dividend, how much was ordinary and how much was preference, and then you speak about how much it is per share. That preference dividend, well, you know that the preference shares are 120,000, and you know that they are an 8% preference dividend. So therefore 8% by 120 gives you that 96, and then the remainder must be ordinary shares. And then the capital expenditure and commitments note. This is the one talking about the preliminary contract. You're basically just rewriting paragraph 8 of the question there, you know, giving the details of that preliminary contract. And then here's the important one as regards our balance sheet. We're going to put in here our tangible fixed assets. We're going to put in a column for land and buildings, for delivery vans, and for total. And you put in how much the information was at the start for each. Take away any disposals, which we disposed of land. Add in any additions, we didn't have any. Revaluation, we did revalue land. And that's our totals. Now, the total here is just a horizontal total of these two columns. Then you have your accumulated depreciation, how much at the start from the trial balance, and then how much during the year, and then one of them was revalued, the buildings were revalued. Again, a horizontal total. And then this figure here, this is the book value at the very start of the year, which essentially is these numbers subtract these numbers, the accumulated depreciation away from the original cost on the 1st of January. And then these numbers, the net book value at the end of the year, is these final year numbers subtract these final year numbers. And this one here, this 981,200, well, that is the key number that we had all the way up here for our tangible fixed assets, that 981,200. So you need to do that note number 5 in order to get the fixed assets, the tangible fixed assets. Finally, there was a little bit of theory talking about how an auditor safeguards the interests of a shareholder. I'm going to leave that on the screen so you can digest that information. That, of course, is also in your theory handouts.